has been a very interesting year for the markets and especially closed-end funds. With me, John Colescott, the president of Closed-End Funds, which is an investment firm that specializes in closed-end funds, as well as BDCs based in Richmond, Virginia. John, welcome. So let's start with interest rates because that feels like it's been the financial story of the year. What kind of impact has that had on closed-end funds?
Yeah, so a lot of people asking about bond closed-end funds, the largest sector about tax-free and taxable funds. Going back to the end of February 2022, we basically saw that there were only 9% or 24 out of the bond funds that were at 10% or wider discounts, and then average discount was about 11.6. Fast forward to this week, the second to last week before the holiday season, we currently have 115 bond funds. That's almost 50% with a 10% or wider discount. And then average is 13.4. And when you back it up a little bit, really discounts are still historically wide. They're about 6% wider than their peak, back in 21 for closed-end funds. And we've really seen that impact of bond prices with generally levered funds, and a challenge of some of the funds, or actually many of the funds, especially investment grade funds, having the average cost of leverage, higher than the average coupon, but that seems to be changing.
Yeah. Well, it feels like this year the stock market was very seasonal. We had the September, October sell-off. November 1, things turned around and we had a Santa Claus rally. What about closed-end funds? What's the seasonality there?
Yeah, so it's interesting. There, we've had about 12 years of discount data. We have raw data going back deeper at CEF data. And we looked at really the tax loss selling season, which happens across the ecosystem. But because closed-end funds are retail owned, they can be more thinly traded. And there's that discount mechanism of a discount elastically widening off its net asset value. We find that often there's a widening point in the fall. So it's usually November, December. So going into Halloween, you have a good sense of where you stand in the sector. We're barely positive on Halloween. In fact, if you go a couple of days, we were negative on the year for a closed-end fund portfolio, and we've had an 11% rally since then. And discounts have narrowed for bond funds about 2.5%, but they've not been, I tell you, we're still 8% below the peak discounts. And we did find something really interesting, Jane. People wonder, do you tax loss sell in early November or late December? And then people go, oh, we'll just do it by Thanksgiving because averages are wonderful. And it reminds me of when the two economists go hunting and the first one shoots to the left, second one shoots to the right, and they go, we got it. That's not appropriate math for investing. What we found at CEF data was in positive years, you need to be in basically November 1st. The first 2 weeks of November are typically the best entry point on the good years for the selling. And on the bad years, there's usually things going on, either known or unknown. You got to be in the second half of December. And so that timeliness has not been commonly explained in the market. We want to share that perspective for our viewers.
Oh, very interesting. And that can make a huge difference in your total return for the year and what you end up paying for taxes as well.
It is, and definitely tax loss harvesting is a beautiful part of closed-end fund investing for retired investors as well as the advisors that serve them. And again, it's always a good time to be keeping note when the markets are thinly traded because that's when there's a chance to make extra alpha.
So the January effect, you also had some interesting findings there. First, explain what that is and then what your data shows.
Sure. So the January effect happens again. It's not just closed-end funds, but we just think there's such more interesting here. Going back through almost 150 months of historical data, the purest month of alpha, averaging 3% up months for a sector that averages 8% a year. So really 40% roughly of the total returns can be gained in January. Not every year, unfortunately, Jane, but basically all but one in the last 10. And that's a 3% move because if you think about it, retail investors and taxable accounts have to get the losses done by year end. You should do it sooner if you're a professional or a thoughtful investor, but there's a release and suddenly you have a new tax year and you can buy anything you want and the IRS doesn't bother you for a year and a half almost. And so that effect is really powerful, really pervasive, and should be part of your general closed-end fund strategy on top of relative discounts, activism following, and then just general sector overweights and underweights per your individual needs.
Yeah, interesting. Okay, so any kind of final takeaways?
Well, in preview, I'm doing a podcast interview for year outlook. While we know it's been probably going to be an 11 to 13% closed-end fund year, that's above average. We do feel, especially for the bond side and the investment grade side, so preferreds and munis and a few other sectors, that 24 is going to be a very magical time where the leverage is additive. Interest rates have topped and maybe some cuts, though we'll talk next, maybe Christmas about that.
Yeah.
And that is a powerful formula for closed-end funds. Their balance sheets well positioned for good returns. And I'm not saying we'll get all of the discount recapture from previous, but there's easily an additional 4% upside in discounts. As I told you, a diversified portfolio for 12 years averages 8% a year. So just the entry point and the tilts can make every difference for these investors.
So interesting. John, thank you so much for your insight today.
Great to be here and happy holidays.
You too.